What is happening, traders? It's been a while since I don't upload a YouTube video, and this one is in response to how to calculate lot size. Okay, I'm not a financial advisor. This and all of my videos and or written content is for personal use and educational purposes only. You must be aware that you can lose money trading the financial markets, and you must trade at your own risk. That being said, let us go into the charts and we will begin with this awesome video, very complete. And just in case you are new, like, subscribe, all that influencer but YouTuber stuff, I'm not really into that. These are the charts, but I'm not going to go into them because I'm going to write stuff. Okay, we'll get into the charts in a little bit, but how to calculate your pips. Okay, I'm going to explain this from a few perspectives. So obviously you can say, okay, you can sort of create a rule that says for every 500 bucks, I'm going to trade 0.05 or 0.10. For every 1,000, 0.10 or 0.05, you know. You could create a little table and help yourself like that. We can do that. Before we create the table though, I think it's important to understand sort of how do you calculate the profit or loss depending on the pips that you're willing to risk with a different lot size, right? Because obviously, if we want to, for example, the market is coming down and we want to buy at some point and we expect a reversal. So it's obviously not the same if I'm, for example, buying up here and I have to risk all of this just in case the market wants to come back and retest this low and then push up, right? So that's roughly like a 1-to-1, close to a 1-to-2 ratio. That is different than, say, let me get that out of the way because it's part of what I'm going to write in a second, but that's different than, say, we're coming down and we're entering at a lower area. See, let's say we entered over here just as it was coming up, right? If the entry is so low, it's almost like excellent. You could lower your stop loss, or rather raise it, meaning decreasing it, right? And so you have a much higher risk to reward ratio. I know you're thinking, how do you know you can enter there? Or like, you'd have to be lucky to get that entry. Well, yes, and precisely because of that, you want to be as precise, right? You want to be as accurate as possible. And so depending on your setup and depending on your plan and your strategy or entry model, however you want to call it, you can adapt or modify completely your whole trading and your whole entry and the lot size, right? Because, for example, in these two scenarios, if this trade you had to open with 0.10 because from here to here, I'm gonna put an example, it gives you $100 of risk. This scenario over here, the same 100 that you'd be willing to risk with 0.10, with that stop loss, with that amount of pips in stop loss, you could increase your volume. Okay, because obviously if you open it with 0.10, that's nothing. Let's say, just to throw numbers, let's say that's 5. This was 50. Okay, I'm going to change it from 50 to 5 or 110. So keep it simple, keep it round numbers and multiples of 5 and 10. So $110. If you're willing to risk 100 off the bat, like today I'm willing to risk $100. If you know your entry is quite, or it could be very accurate, or you're gonna really, you have a system that is offering you a degree of very accurate entries, you could purposely increase your volume but decreasing your stop loss. You'll still risk the same amount, but you're allowing yourself to be a bit more aggressive in the volume, not necessarily the risk, but the volume. You're keeping the same risk, and so your potential for profit is multiplied. Not only that, you can even get out way before to get the same or more amount of money than having to hold a lower volume position for longer. Let's say your target is $100. So here you're risking 1-to-1, right? I'm gonna risk 100 to win 100. With 0.10 lots, maybe you'd have to wait 1 hour for the price to really expand. Whereas if you're opening with 0.50, for example, because you've decreased your stop loss, you don't have to wait all that time. Almost half the time you can get those same $100, right? So you're risking less and potentially getting your goal much quicker, much faster. So that's a very powerful method that depends on your entry model, because clearly if you're waiting for a price to start confirming it wants to go up, you have to beware that the margin of error is more, right? If you're trying to catch the reversal from the very bottom, you could be more aggressive. Now, I'm going to sort of illustrate what sometimes I like to do. I'm setting up my buys with a very tight stop loss, and I don't care about the take profit. I just know that I have to respect that I'm going to only risk 0.50 or 1% for every shot, and I'm going to take 3 to 5 shots. In other words, my worst day, I'll lose 5% if I lose every shot I attempt, which is not that, it's not, that's rare. I mean, I have to be completely wrong. I have to misread everything, and if I lose a fourth trade, I'm like, okay, you know what? I have to do something. I have to clear my head, maybe go get a coffee, come back, or whatever I need to do, and then try one last time. And if that's it, I'm done. But the entry model and the strategy and my method, I've been able to, use effectively, allows me to do this, because the minute I get that one single shot right, I am getting close to 5 times more than what I'm losing. So as price is coming down into an area, and this is very important, I'm not just buying price as it's coming down. I have areas I'm waiting for price to get to. And if it gets there and I'll start seeing rejection in the 1 minute or the 5 minutes, then I'm executing. Okay, this could be a previous daily low, a 4-hour low, and anyone out there who's trading supply, demand, ICT, smart money, Elliott wave, and you're catching the 61% retracement, or if you see rejection in the 50%, see, these are all concepts they're there. I'm just simply expressing myself differently and in terms that I understand. And the way I've learned to interpret price is basically how I call it the V-shape. That's one model. That's one method I use of a few of them. But the V-shape basically is, I want to see price come into an area where there's liquidity. Where is there liquidity? There's probably let's say this is a 4-hour low or a 1-hour low. And so I'm waiting for price to start coming down and then see it trying to get back up, and then come down again, and then I see it come back up a little bit, and then I'll see it again coming down here. And so that's telling me like it's price is coming under that higher time frame area low, where there is orders resting, sell side liquidity, and it's reacting, it's rejecting, it's coming back up, it's trying to come back up. And as it keeps coming down, it comes down forcefully. You see it come down a little, like it try to struggle, and it rejects, and then it comes down and it rejects. And so that shows you the candles are speaking to you. They're telling you like, we're trying to come down, but it's like it sort of hurts, and they hurt and they bounce quickly, you see. And eventually you find the V shape. So as price comes down, I illustrate lows, I mark them, and eventually, now here's the thing. It's not just eventually. Time is key. And the setup I'm using is New York session opening. The opening of a session in a bullish trend. Like, God, I mean, I don't have to, I don't want to explain and completely change this video about the V shape, but the time is key, guys. You're not going to be buying at 4 in the morning, or, it's in New York session. If it's a bullish day, you're not going to be buying at 8, because if the session is going to start bearish, it's going to trap sellers, it's going to induce selling. Algorithms are going to create volatility and expand down to offer institutional orders to get triggered at a better price. So that's just a tip of an iceberg. But anyway, my strategy then, I'm waiting for price to be here under 4-hour lows within this 1-minute structure in between a specific time window. And once I see that price indeed rejects quickly back up, right, and breaks a previous high, that's the beginning of my setup. Okay, so there's a video on this, but basically this is one, excuse me. So there's going to be a first push below a low in the 1 minute. You'll see a second push closing back above a low. Keep in mind this low would be like the bigger, higher time frame low. That is, actually, it would be all the way to the left, because you can't see the 1 minute right next to the 4-hour low. So this would be all the way up here. This is the area that I know price is dipping below to get liquidity. So that over there is the 4-hour low. I see the 1 minute coming below it and doing this. So as you see, this is a little V within this big one. But basically, this is 1, 2, 3 below 1. You have 4 above 2. I copied that by accident. And then you have this 5, right? So, geez, I'm sorry. Okay, so this is more or less my strategy, basically. And this is how you could also interpret this as a change in price delivery, or a shift in market structure, change in character. There's different terms. I just like to see a V. That's what my brain sees, and I call it a V shape. And it's basically 1 push down, 2 goes back toward the top of a range, 3 manipulates 1, and then 4 is above 2, 5 respects the range between 2 and 3. I've sent this like a gazillion times on my Instagram. I'm sure you're very familiar with it, but how does this connect to all we began talking about? I'm trying to execute trades as this price comes down here, as it's coming down, because I know eventually I'll get it, right? And so I'm seeing if price rejects here, I'm entering one time. See, because I think this would be 1, 2, and this might be 3, so I think I'm going to catch 4. I don't know exactly when it'll be 3 to 4, but that's precisely trading. You have to risk it. And so I'm having a tight stop. Why would I have such a tight stop loss? Well, in case I'm completely wrong, and maybe there's an area that I missed for some, maybe even lower. And so why would I just do this just because I know I might get it right? Like, no, that's the extreme side of it, and that's not really being smart about it and moderate or conservative. You want to just, that's why there's a saying in trading. It says accept losses. It's a toll. It's like a fee. It's a cost. So I'm willing to lose that 0.5%. I'm willing to get to the minus 3% total drawdown, but I know eventually when I do get that nice reaction to the upside, as soon as it's coming up, I'm doing this. I could literally just put my stop loss right on break even, because it was a high volume and tight stop loss. It's right up there. I'm already in profit. I could close and cover my loss and try and enter again. That's just one way that you could do it. But what I'm doing basically in the end is holding that trade that I managed to nail right basically almost at the wick's bottom. And I can now I don't have to hold forever to A, get the losses I've had trying to do that, and B, you know, finishing the day in profit or with the goal that I have, or if I manage to hold it, well, I'm flipping money. So that's one way in which you are increasing your volume but not increasing your risk, because your precisely your entry is such that you allow it allows you to decrease a stop loss. It's not thinking more lots. It's actually saying, okay, if I'm gonna try and catch the very bottom of a reversal, I could. That means I would be risking less, because it'll be almost immediate that I could get the entry to be profitable. So I might as well risk in pips very little, and because it's so little, I might as well increase my lot size. Why not, right? Different if I miss. I'm like, I don't know, I'm using my phone, or I maybe just writing a message or something, and I already, because this is minute to minute, excuse me, because this is minute to minute, maybe I missed that nice reversal and I already see four, which is from the bottom, from this bottom to that, middle. So what is that to me? That's confirmation. Okay, so then I see, okay, I'm going to wait for that little pullback, which typically is respecting 2 to 3. And some of you would say, there's a fair value gap or whatever. And it's true. Yes, that's where you might find a fair value gap. And so you could enter anywhere around there. But what is the rule about that? You have to put your stop loss at that low in case the market just flips or continues to the downside. And so, yes, this is quite a safe / moderate stop loss range, because most times if it does extend a little bit, it'll respect it and then turn back around, right? But the difference with that entry, obviously, is that the margin of error that is required is all this from here all the way down to the low. So that's almost 5 times more or 3 times more than the other example. So here I am forced to decrease the volume because the pips in stop loss are wider. Okay. Should you do both? Yes. Should you do only one? Sure, it doesn't matter. Just try it, give it how do you also some people, how do you resonate with the strategy, or how do but basically what suits you better, what suits you best, your personality. Can you navigate the adrenaline and control yourself not to breathe too hard and and not doubt yourself? Can you have the balls really, that's it. Can you just not think about the money and just execute low? Try and get the low. If you lose, don't think about just try and get it 5 times. That's it, you're out. If you lose 5 times, have some self-control. That is where you have to have self-control and just get the hell out of the charts. It happens to everybody. It happens to me. Sometimes I lose it and I revenge trade. Oh my god, you revenge trade? Yes, I fucking revenge trade sometimes. I get pissed off. It's normal. Should I? I don't. I shouldn't. Some days I should. I don't know if you like soccer, but what's this guy's name? I completely changed the topic. Sorry. Sometimes I think of a gazillion things at the same time. What's his name? Buffon. I think Buffon or Gattuso. He was saying, sometimes make me good, sometimes make me shit. It's like, all right, if you know soccer, and you'll be laughing. If not, completely ignore that. And so, going back to this, how do we choose the lot size? Well, clearly you do have to have a degree of understanding about yourself, in the sense that, are you a risky person? Are you a more moderate person? If you're a risky person and you don't mind losing 5% on a single trade, you're quite aggressive, and so you could increase your lot size, or this might actually, you might like this idea that you're risking 1%, and then right when you get it, you can get back that 3-4% you lost and an additional. I wouldn't be doing this with big accounts, like with big accounts, like for over 10,000. Just that's like a machine, an ATM. You with that with such like this is to get bigger capitals, like say from like 500, 300, 1,000. You maybe want to flip money, and it's possible. It is possible. This is not crazy. And some people would be like, that's not responsible. Like, that's not, on the long run, that's going to be unsustainable. Like, well, yeah, no shit. If you obviously have $10,000 and you're risking 5%, it's like the numbers can be wild. If some people are doing it, if you're listening to this and you've done this, yes, like, both ideas are valid. The risky people will say that's totally true. I've done it. I have 100,000 and I'm like fucking making 10,000 a day. Like, great. And others are like, I lost it. I just it's unsustainable. And so like, hey, everybody's got their opinion. Everybody's is right. We're telling the truth from a different angle. What I'm trying to what I'm trying to put across is you can do A, B, C, D, E, F, G. And so this is A, there is B, etc., etc. And okay. All right. How is everybody doing, by the way? I know I'm going a little bit faster than usual, but like, subscribe, blah, blah, blah. I am not a YouTuber, but you know what I mean. Okay, so lot size. Gold pays you $1 per one lot. Or I'll say it some in a different way. So price over here, my chart, I have 2 decimal points after the period. Some of you might have 3, I don't know. But in most cases I've seen is just like that. You got the price, 3,000 something, point, 2 decimals. Okay, and so the way I just do it, by the way, I have an expert advisor in MT5, and I use my Stream Deck to trade. I don't know I think you can see that. So I have the buttons, and it tells me buy, sell, close, and it already has all those numbers down, and it calculates the lot size depending on the percentage of risk I edit it and I choose to that's in that particular trade. But the way you could do it with a simple calculator, you go to price, and let's say, just to keep the numbers easy and fast, let's say you want to buy at 3,000. I don't know, let's say the price is 3,050, and you want to buy there, and your take profit, you want it at 3,010. It's not a crazy increment. It's a reasonable target within one session. So the way I would do this is I grab my calculator and I write the price without the period. And so that would be 3,000.50, but I don't write point. It's just, so it ends up saying 300,050 minus 3,010.00. That would be 301,000. It gives me a 950 point difference. I know it's negative, but don't ignore the negative. It's the number. So 950 different points times whatever lot size you are trading. Let's do 0.10. So that's 95, right? So aiming at 950 points with 0.10 lots, I could potentially win $95. Question would be, how much am I willing to risk with 0.10 lots? We just seen a few examples of how you could play with that. But let's say you are saying to yourself, I'm only going to trade 0.10 and I will only risk 100 pips or 100 points. So 0.10 times 100 points is $10, which is actually a little. And honestly, 100 points it's quite aggressive. I have seen that 200 to 300 points in gold is a reasonable stop loss in a 1 minute time frame. You can catch. If you're accurate enough, you'll be good. So fine, let's do 0.10 times 200 lots. That's $20. Perfect. $20. Risking $20. What do you think is appropriate to have to be able to risk $20 in one trade? How much money do you think it'd be reasonable and logical to have? I personally think at least 300 to $500 at least, right? Because that would represent 300 minus, I think that's like 12%. 264 minus 300, 36. Yeah, it's basically like almost that 10% in one shot. So how many shots do you have if you lose 5? That's half your money are gone. You see where I'm going? So you want to, and so are you an accurate trader? Do you sort of, are you still struggling with your accuracy? Well, if you do, then forget about 0.10. You go to 0.05 and you're risking 10, or anyway, you see where I'm going. So for this is where you do want to have a little table. So and what I did, I didn't write it down here, but what I did is, so I subtract that. So the price I'm entering versus the target, that is 950, I think. 950 points. And so you multiply that times the lots. In this case, let's say 0.10, and that would equal 95. Right? So this is how you calculate the money that you would be making depending on the lot size. So obviously with the price and the target. Okay, and so what else? Where was I going with this? So okay, so the capital, yes. The size, your account, your balance size. Well, okay. So for a beginner trader who's trying to make it on his own or her own, I would really, it's reasonable. I've done it. It's a myth that you need at least 10,000. Oh, you're not gonna do anything with less than 2,000. Like, man, you can flip accounts. It's possible. I know a lot of you have lived it yourselves. Like you've made like you've crazy money and you lost it all. It's possible. 200, 300. I'd say the sweet spot for just starting 300. 300 is what you could spend in a weekend partying your hands off. Like, just might as well save it, fucking risk it in the market. You can potentially make 1,000 in 2 weeks. So $300. You're gonna start with $300, and you're gonna, for this, you would trade 0.03 to 0.05 tops. Okay, like average 0.03, and that is based on this whole calculation of that roughly 200 to 300 pips are reasonable in gold. So you have to say, okay, if I'm going to risk 200 pips times 0.03, that's $6 is not bad. 6. So $300 minus, and you start playing it. You start, okay, 5%, 285. That's 15. So it's not even 5%. It's not bad. So it's 50. It's almost like you're risking close to 3%. So 300 minus 3%, 291. That's it. Basically 9. So you're risking 2% per trade. Not bad. That's perfect. That's the sweet spot. 2%, 3% every trade. Okay, so that's representing on a 0.03 with 200 pips. So let's say you say, okay, I have two strategies. One that is aggressive, in which I can decrease my pips of stop loss and increase my pips, my volume. So what does that pip look like? What does that lot size look like, right? I think I said it wrong. I have a model that says I can increase my volume, my lot size, because my stop loss is my entry is gonna be accurate, so my stop loss is gonna be tight. What is that lot size I'm gonna pick? Okay, so you have to define that sort of, but what I'm saying is 200 to 300. So maybe 300 could be 0.03, and then 200 to 100 with 0.05. You see where I'm going, right? So you're developing different entry models, and according to your intuition as well, if you sort of like feel you have the edge of getting a nice trade, try it. Risk, increase your volume a little bit, decrease your stop loss, pers- uh, what's that word? Proportionally, and you're not playing around with your risk. You're not fucking around with it. You're not being too risky, or it's not about being more risky. It's just being more accurate, right? And so anyway. So okay, so 300 0.03 for $500. I would actually stay like this. Um, I would stay like this, 0.03 to 0.05, because I'm doing 0.05. So for every $500, maximum 0.05. Yes. And so right now I would wait until I get to 1,000. And with 1,000, then you can start trading from 0.05 to 0.08 roughly. Yes. So I'm going to create that little table for you here, depending on your capital, and these could be like checkpoints, right? Like stepping stones. I want to get from 300 to 500. From 500, let's get to 750. Yes, 750. And for 750, you can increase a little bit. I would roughly just stick with 0.05, and here do 0.07 tops. And here I would do something like this. Again, why? Because 0.10, 200 pips, points, or whatever the decimals, you know what I mean, times 0.10 is $20. Of 100, sorry, of 1,000, 1,000 minus, I think that is 2%. So 1,000 minus 2%, that is 980 and so minus 1,000, that's your $20. You see, that's 2%. It's a realistic goal to also trade. So why? Because if you look at the movement of price in gold, it'll move at least 200 to 500 pips in a few minutes to an hour in a nice New York session, key algorithmic time. You're catching a reversal. You're hopping in with the institutional order flow that is a nice violent push that breaks market structure. And so you're entering the moment in which is going to change the market, and you could be out then. You see, that's the interesting and the power within this. Anyway, let's continue. So 1,000, and then from 1,000 I would be working by 500s, and then eventually by 1,000. So that would be my next stepping stone, and I would do 0.10 to 0.15, and then next I reach the 2,000. 2,000, I would be with 0.15 to 0.20, and then 2,500. 2,500, I'm sticking to 2,000 to 0.20 to 0.25. You see, and so on and so on. And you could actually stick around longer with a specific lot size until you reach higher levels. For example, from 2,500, you can just do that until you get to 5,000, because as a matter of fact, with 0.25 lots, 0.25 times 500 points that gold moves in a session easily, that's $125. 125 times 10 trades, that's already 1,200. So from 2,500 to 3,000, you're going to do it quick. So you could stick longer with that lot size because it's reasonable, it's realistic, And it's powerful. Like making $100 in a few minutes, it's insane. It's really good to start with a small capital. It'll get you to that 5,000 mark with discipline in about 2 weeks. You know, if you focus, you do nice trades, 2 to 3 trades per week, potentially holding all of New York session, catching a nice bullish trend. You know, we've done this in the VIP and on the Discord. Some signals I've sent for free have been intraday to swing trades. This is possible. So I would be working for longer, starting at 2000, even 1000. Like I could stick with 0.10 for a month and make your way up to 2000 easily. But again, we're doing this example so that you have roughly these stepping stones. And from the 5,000 mark, you should treat your capital as a money making machine, as an ATM, as a store, as a however you want to think. But basically, you have that capital working, generating a weekly income. You secure it, generate a weekly income. You withdraw some. You start paying yourself. You literally start living off of this, and so you've got that checkpoint of 5,000. You're generating 100, 100, 100. How much did I make in a week? Oh, 800. Get it out. You did it once, you can do it a million times. Same 5,000, generating, get it out. That's just one way. I'm just thinking out loud. You could obviously go till however you want to go, 100,000. I don't, it's just an idea. But with 5,000, this is where I would be, stepping a little bit into the 0.50 tops. You could do 0.25 to 0.50. You could sort of double your volume here. Even a lot, one lot. Okay, but then one lot, as you know, if you are gonna risk, if you're gonna risk 200 points times a lot, that's $200. So $200 of 5,000, that would be roughly. That would be almost 5% in a single trade. That's a lot. So, one lot would be if you're, I don't know, you'd have to really time well the market. Whereas 0.50 times 200 points, that's 100. Not bad. That's, a bit more reasonable. So one lot I would say is like sort of extreme. But okay, this is it. And now this is all thinking. This is all thinking that you are risking 2 pips, 200 pips to 300 pips of stop loss, right? So I'm going to put it here so that you know that that this is the 300 and the other one is 200, okay? Yeah, I'm sorry, you guys. I'm just a perfectionist, and I want things to be symmetrical and perfect and beautiful, and so you're just gonna have to bear with me. Okay. Some of you are like laughing. It's like, I do that too. Yeah. Good. I bet your notes are clean. That's how it should be. Din, 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 din. Okay, there you go. That's beautiful. So this is what I'm risking with that capital, those 2 options of lot size. And the total amount, is 2%. So this is to risk 2%. Risking 2% per trade with an aggressive model and a moderate model, entry model, however you want to call it. Or aggressive or not, however you want to define it, but essentially it means an entry that you feel very confident with, or an entry that you're sort of like, I think I'm going to, just to feel better or feel more safe, I'm going to increase a bit the pips of that stop loss, right? But more or less, you want to be risking 1 to 2%. 1% to 2% per trade. Right? So you could adapt all this into that 1 or 2% threshold. Okay. So again, subscribe, like, share if you're blah, blah, blah. Okie dokie. So what else was I going with all this today? There's your little beautiful table. I think that's it. Your target, you could aim 1 to 2, 1 to 3 ratio if you think about it like that. I like to set my targets based on market structure, so previous high or maybe an imbalance or So let's see if we go to the. Well, actually, let's review this trade, which was the latest VIP signal I sent today in the New York session. So 1 minute time frame. In this 1 minute time frame, I was seeing that price obviously coming down strong with Asia. Asia is usually a big snitch in the market, and so because this New York session was bearish, in the end, you see the PM session was selling. That triggered Asia to come up, grab liquidity, and sell as well. And so Asia is listening to New York, and they dump, and so London is kind of hovering, chilling, setting up New York. It's telling it, okay, we're going to manipulate this area and we're going to distribute to the downside. And so here I remember I measured this drop, and anywhere above the 50% would be the entry, and right above the 50% right here, that's where we could expect price to come down. If we go to the 5 minute, we clearly see that market had broken out of this area right here. So anywhere above, at and a little above this would be a reasonable area to sell. I see in the 5 minute as well, this little guy right here, that's an imbalance as you see it, right? Those two candles, let me zoom in so you could see it right there, that wick. There is your imbalance, and that is basically your selling area. It could have been more. Don't get me wrong. I remember I was talking to somebody before the session, and I said this area I would like to see price shake hands with it. I would like to see price go back, retest, and just before it failed to get there because of that little guy there that I missed. I missed it, but what I didn't miss was the time. I'll show you in a second. But basically, this was the selling area. Notice how price tapped just above it. So you have two things. The 50% retracement of that nice push that Asia created. And so, up and above the 50% would be a premium entry price. And then you have New York. Look at the time. 9:30, 9:35, 9:40. Between 9:30 and 10:30 a.m. Eastern Time, New York, you will very likely see the market grabbing liquidity at some point, reaching an imbalance, getting into a fair value gap, whatever you name it, however you want to see it, whatever. By that time, you'll see a change in state of delivery, or you'll see price make a pullback to continue a trend, right? It all depends on the market structure of previous sessions. But in this particular example, because New York opened to the upside right away, it was suspicious. It was like, okay, this might be chasing prices, is might be looking quickly to get somewhere in order to sell. And so we were waiting, and I can show you, I think, how we were projecting this. So right around here, you see, this is the 1 minute time frame. This is what I was that was the area. I had a wider area. It wasn't necessarily that little fair value gap or the imbalance or however it's called. I'm not even an expert on that. But that area was around here. I had marked all this bigger area. And so anywhere around there, because it was 9:30 and I was starting to see that rejection to the downside, I was like, okay, this, we might as well take our chances and executed that short. And then so that was the take profit. But I was going to discuss the take profits. So how to execute, or how to get out, where to get out. Okay, so you do the same based on the price action and on market structure. So you know this is a new, like, as you know, that price is reversing. It'll target previous lows or previous highs if it's going up. And so just before these lows, I'll be setting my personal take profits so that I get out before, in case it wants to respect those and then flip back. So that's one take profit. Here's another take profit just above it, as you see, just before getting to that wick. And then essentially over here, eventually all this area of traffic that it could have acted as a support in the future. So we all secured profits right here. And that's where actually price bounced quite hard there. You see that? So because of that, it was already almost midday, and usually midday, the PM session could have been consolidated and then come back up. So it's a wise thing to do also to close before midday. If you want to hold it, sure, you could have held it, and that was a beautiful trade. But it was, where I'm going was the targets, right? So, okay, you got your model that is a bit aggressive, or you got the model that is less aggressive, a bit more conservative. Where do I get out? How, I hold my trades, and then it doesn't get to my take profit. It flips on me. Like, what do I do? Maybe you have to be a bit more, a bit less ambitious in the distance that you're willing or you're expecting price to go. Go to the 1 minute, 5 minute time frames and target previous lows or previous highs. So the 5 minute time frame on this particular day, the wicks and the candles. So this candle, right on that candle, there is a potential target. Those wicks, right on those wicks, that's a potential target. This body's low, that's a potential target. This little guy by itself, this little dip, that's a potential target. Eventually price gets there and it stopped. Okay? I can't say if price is going to completely break this, but in the short term, these are realistic, reasonable, and most importantly, when you catch with the lot size we discussed, look at price. 3,367 to 3,343. Let's do it. Let's do the example so you kind of also understand the dimension of it and sort of like, have these examples. 3,367.50 and 3,342 flat. 3,342 flat, right? Minus 3,342 flat. That's 2,550 points. 2,550 points times 0.10, 255 US in one session. You see that? 0.10. Let's go back to our table. 0.10. How much would you have to have risking 200 pips or 300 pips? Let's see here. Where am I? Sorry, guys. I got lost again in time. Oh, down here? Here it is. So 0.10. Okay, so we have 1,000. 0.5, let's say it was 0.5. Well, it'll be half. So if it's 250, it'll be like 110. $100, $100 to $130 in one session with 0.05. So from 300, you're finishing the day with 400. That is a crazy increment percentage-wise. So 300 plus 20%, 360 is more than 20%. 300 plus 30%, 390. It's basically 30% of your money. That's crazy. That's crazy. And it's real. It's real. It's real. I know many people have done it. And being accurate with a model that offers you a relative high percentage of win rate, the sky's the limit. Um, okay. Anyway, I think I'm going to stop this video right here. It's under an hour, but I think very complete and very educational. And I hope this helps you, clarifies a lot of things. Do hit subscribe, buy, share, whatever, blah, blah, blah. Take care. Hasta la vista.